It's Thursday, November 25th, 2021. And today we'll be talking about 5 major trends that we are seeing in the Canadian tech ecosystem across funding, talent, Web3, fintech, and COVID reopening. Let's get started. First, we're going to be talking about what's trending in funding, Alex.
Hey, Jason. So where do you want me to start?
I'm thinking about what you're seeing in the funding landscape, and if you're seeing any difference between raises that are happening today versus what you've seen in the past.
So let's start with some context. Everyone's talking about how this year there's so much funding, it's a crazy amount of volumes, but everything is very surface level analysis. And that's one reason we do quick takes, to take it apart and explain what's going on. But as we get end of the year and I was starting to look at trends, I said, let's look at what's really going on here. And so there's two things going on, and they're both relate to the same thing. The funding is great, but it's going, what I say, flight to quality. So do you want me to explain what I mean by that?
Yeah, that sounds pretty coded. What does flight to quality mean?
So people are willing to write checks and give crazy valuations, but to who they perceive are the best companies. We've talked a bit about momentum investing. That's a bit like that. And so if you look at it, it looks like the best financing time ever to go raise. But it's a subset of companies that are perceived to be better than others that are raising extremely easy, and everyone else is taking a long time to raise. So I'll give you an example.
Let's unpack that. Yeah, thank you.
So let's and there's two things that happen. One is companies that have a lot of momentum, have a founder in a great space, have a great founder in a great space, are raising large rounds quickly. So let's go back to a few examples over the last little while. Float raised $30 million. You know, if you figure out the metrics, it's probably their valuation's way higher than the metrics, but they're growing quickly. You have Rob Kazam, you have Brexit rampant estates, so people understand that. You have companies that are later stage that have proven out their model and are getting fuel to fire, like Clearco, that can go raise, or are fair, that can basically raise anytime they put their hand up. I think if you talk to Marcello and said, you just closed, what was it, $400 million a week ago? If you said you want to go raise another $500 million, you could probably go do it because the model's working. It's a huge market. It's scaled. They've proven they can execute.
So let's talk about the other side, Alex. Who's not raising in this market then?
Let me finish. Sorry, one more thing about this. So you get these companies that have an easy raise, but they're also getting the bulk of the money because they're raising disproportionate amount when they raise. A $30 million Series A in Canada is the exception, not the rule. Now, so who's having trouble raising? Is the founders that have taken time to build a quality company and are just showing that hockey stick curve, but aren't that famous. They aren't in the hot area. So maybe, let me pick I'm just trying to think of a current raise, but it's hard. You don't even think of them right now. But it's like when you see that A round, that's $5 million. I bet you that person took 6 months to raise, and her company may be great, but she took time getting real product market fit, understanding the customer development. She graduated from University of Windsor. Nothing wrong with University of Windsor, but it's not University of Waterloo, and never worked at a big tech company. So when investors look at her, she's like, okay, it looks like it's working, but there was no momentum until 2 months ago. I don't know who she is. I don't know. She's doing something in the parking market, like finding parking spots. So she can raise, but it takes 6 months versus a few weeks, and it's a $3 million raise instead of a $30 million raise. And we don't talk a lot about those because they're not exciting, but they're happening. But they're happening slower than they have traditionally, for a bit more money than traditionally, because everything's up in valuation.
Got it. So we're seeing really a tale of two types of founders, some that are raising really easily and bigger than ever, and others that are taking longer and it's still a hard road, just like it's always been.
Just like it's always been. Like the stories of a quick high valuation raise is the exceptions. And the problem is now those exceptions are getting a lot more money a lot quicker. So it seems like it's easier, but if anything, it's harder than normal. And one reason I don't want to mention names, I don't want anyone to feel that I'm not saying they're a great company, because they are great companies, but I don't want any founder to call me up after and
they'll call you up after anyways, Alex. I'll always give
if you think I'm talking about you, I'm not. I'm talking about someone else.
Okay, now let's talk about the end of the private journey of funding, which is going public, IPOs and SPACs. We've been talking about a heck of a lot of these over the past little while here in Canada. What is going on?
Well, I think you've got two different markets in Canada and the US, and you've got IPOs versus SPACs. And I think when you start seeing companies go public again, in all three situations, In all three scenarios, they were all doing well. They were all perceived well because there was such a demand for tech companies, and companies hadn't really not gone public in any volume for like 10, 12 years. And so I think the first one, it's sort of, you had a few private list, what's called direct listings in the States.
Hmm.
Those went really well. Then SPACs are becoming popular. And I think the first few SPACs, when there's less competition out there, were perceived as high quality, good things to invest in. And now you're seeing a selection bias in companies that go public via SPAC, either highly speculative, like, hey, let's take a jet, a taxi jet or helicopter taxi, or companies that are not perceived that they could not go public via the normal route, like mansplaining. I don't know if you know about that one. No, not
No,
mansplaining. What's it called? It's one that it's
that
focused
would be an
on.
unfortunate name
No,
for a
no,
tech
it's no.
company, I
It
think.
should be called mansplaining because it's like a man beauty kit aimed at down there.
Okay.
So you look at the metrics; they have good growth, but looks like slight decent gross margin, but doesn't look like a great company. Doesn't I don't think they go through the normal public growth. So they're starting to
Right.
see harder to get SPAC deals done, and they're getting viewed more skeptical. And there's lots of broken SPACs, which means it's announced and they don't get the funding. Then you
Right.
look at the IPO market in Canada and the States. I think so what's going through the normal IPO market in the States is considered high quality companies that are generally doing really well. That's being because they're alternative would be go to SPAC. And then
Hmm.
in Canada, we've had a lot of companies go public because it's been ages and we have a lot of great companies go public recently. But it seems that it's not like the market's being a bit more careful on which ones they increase in value over which their lukewarm entrance. Like Covio went in public this week. I think it's just had
Hmm.
a tremendous reception. The founders had 3 public companies before. They have great numbers. Thinkific was another successful ones, but there's been quite a few that have come out and sort of stay at the same prices, which is not what you expect for an IPO. And so you can see it's interesting. SPACs, one market, US IPOs, another perception, and Canadian IPOs, a different perception.
Okay, now let's talk about the middle of funding and those exits, which are accelerators. More
Yeah.
or less?
Many new ones. We've talked about them. As a founder, you have access to many more than you've had in the past, right? So if you go back a few years ago,
Hmm.
it was the news when TechStars entered the market. They came in with TechStars in Montreal. They had TechStars in Toronto. They had the prop tech accelerate TechStars. Then you had like Accelerprize, which is now changed to the Forum, but accelerators have accelerated in the last 18, 24
I
months. There's
knew it was
EF,
coming. I
there's
knew it was
EF,
coming.
there's Antler,
Yeah.
there is then there's ones that are global, like YC's is being keeps on expanding its class. You have what's it called? On deck. And
Hmm.
so like there's more choices than ever. And the question is, which of them actually have a reason to exist? And I think you're gonna find ones that have very specific niche cases. Like, look,
Hmm.
EF and Antler, they're saying, hey, we have talent. You don't have a founder. We're gonna put you through a program that's extended founder dating and set you up for success.
Hmm.
That makes sense. We don't need, we had none of them 2 years ago. We're gonna have 2 in January, and maybe so that's that's 200, 300 people in Canada. That's probably the right amount. But like, and again, I get pinged like once a week about another accelerator opening up in this country somewhere. you know, do we need all
So why do
these?
they exist? I see there's some that have a clear niche. What about the ones that don't have a clear niche? What role are they? What role are they
So so
filling? Where's the
so
money coming from? Why are they doing it?
many different reasons. There's a lot of corporates that think we need to have a program out there because it'll help our innovation, it'll help us be more innovative and build an ecosystem around us. There is government saying, hey, we need to get more innovation ecosystem here. So and like, oh, let's go partner with the university. Let's do something. So like, if you were to look up the number of accelerators that didn't exist 20, pre-COVID, or just let's say 36 months ago, and that exists across this country,
Hmm.
there's a lot that are trying to solve some ulterior motive and fix a broken economy by saying we're going to create innovation.
And are
And
these
so,
any good for the founders?
look, any depends where the founders are from. I think a lot of them. I think a lot of them are at best neutral.
Okay, so if you're a founder out there and you're interested in the accelerator route and you're trying to figure out the landscape, the new ones, the old ones with track records, what their niches are, how do you get started? How do you figure it out?
Well, I think the first thing is you're saying, hey, want to start a company, or I have started a company. So like you can even start where you are in the journey. There's ones that are pre-starting a company.
Hmm.
There's ones that are post-starting a company, and you have to figure out, what help do I need? What am I trying to get out of this? Am I trying to get branding? Am I trying to get a network? Am I trying to get access to talent? Am I, and then you try to find the ones that suit your need, opposed to looking all them out there and choosing one. Because I think most people say, oh, there's 10 accelerators in my hometown. Like, there's like in Vancouver, SFU has one. I'm sure UBC has one. There's CDL, right? You should, before you start looking at what's out there, you should say, to accelerate my or increase my chance of success, what do I need? And then you should then do a search based on that. And then you should go verify with people who have gone through that program that you actually get that. Because lots of VCs, lots of investors will promise you stuff
Yeah,
and they
but
don't
there's no
deliver.
one place to go to check all this
Yeah,
stuff
but
out.
so go look at the portfolios of companies on there and reach out to the founders. And
Yeah, that's a
I
good
think,
one.
the other thing you have to do is, what is the cost of doing this? How much better off am I?
Hmm.
So you are you're explicit. At least you're paying with time. Some don't take any ownership, but you are paying with something, and you have to go, what is my cost of doing this? And am I better off or worse off? And you'll never know, but you have to make an educated guess.
Okay, now once you've got funding, whether it's been easy or hard for you, whether it's been IPO or SPAC, whether it comes to the accelerator, you got to spend it somewhere, and they spend it on people. So I'd love to talk about what the market for talent is looking like right now for Canadian tech companies.
So I was at dinner last night, talking to a few founders. And one founder told me she had relatively junior machine learning uh, engineer quit. She asked, where are you going? He goes, I'm taking 4 months off to travel, and I know when I get back, I'll have 10 offers. That exemplifies this market. And it's engineers, it's data scientists, it's BDMs, it's salespeople. It's basically anyone you need to build a startup. That if you want someone who has high learning capacity and good experience, it's not a knife fight, it's a gunfight.
And that's a junior engineer. So you
Yeah.
even say good experience. That's pretty early. And when that person comes back from their 4 months traveling for their 10 offers, is it the same salary? Is it lower? Is it
So
higher?
again, salaries, if we're are going to what they are in the valley at the least. And what I've seen is a lot of startups are giving raises off cycle because they're worried about getting poached, and they figured we're better off to give it 3 months early, 4 months early, and give a raise, and the raise are
Mhm.
substantial. And this goes back to what's happening here. Those high quality startups are raising tons of money. It has to go somewhere. They don't want to lose. They now have to go make their growth targets, and they
Right.
need talent, and they'll pay 30% above market rate, and so that forces everywhere to go up. So the valuations are pushing salaries up, and a lack of talent, just generally is pushing salaries up. So depending on what you're doing, my guess is salaries can be up 20 to 40% for engineers.
Wow. That is a huge number and makes a huge difference on your burn rate when you went to raise. That's for sure. Now, one of the big ways that people build their employer brands at the early stage is by announcing those big fundraisers. How's that working as a strategy for attracting talent
So
today?
let's go back to announcing rounds. It's if you go back 18 to 24 months, especially early stage, most people did not announce rounds anymore. There was viewed as no benefit. It was only inviting competition because they viewed money was so loose. Um, Now you're seeing people announce rounds quicker, and I think some rounds are being done just to announce them. And the idea here is, how do we entice talent to come here? Talent who has choices everywhere. It's usually more than money. So there's two things you can do: show you have a very strong mission that, so for example, there's a company called Vivid Machines I'm familiar with. They're doing uh, visual machine learning for the ag tech ecosystem, or for ag tech. So for like visual, like for produce. And it's
Hmm.
interesting. They're just out of all the talent that comes inbound to them, visual machine learning, passionate about produce. So that, like, they're coming there for the mission and challenge. And
Yeah.
if you are somewhere, let's say we'll talk about fintech later, which is a lot of options,
Hmm.
then the other way to validate and attract talent is get outside validation by announcing a large round, which implies you have momentum. And then also, like any Tiger Global round, they're being announced because, hey, look at all the money we raised. We can hire you, we can pay you, and it also implies that Tiger invests in fast growth companies.
Hmm.
Let's do it. I'm sure in crypto, A16Z has that certain badge of honor, or Sequoia traditionally has that. So these rounds are now being announced when they normally wouldn't, because it's a way to scream to talent. We're fast growing. Look at our backers. This is a safe bet for you to go make money off your equity and get paid well.
Yeah, the FMV of your equity is already high, so work harder to make it higher.
That's also goes. So I think lots of people are going, and again, this is more maybe American than Canada, because I don't know what the tax implications are here. But people are going from paying options to doing RSUs.
That's a big trend as well. You're seeing.
Yeah.
Interesting.
And just so people don't know what that RSUs are, restricted shares. So basically, if you get an option, traditionally get options that says, okay, the company has to go up in value for you to make money, and RSUs are saying we're giving you shares. So even if it goes down in value, you're making money. Now the trade-off is it's the same economic value hypothetically, but so they give you a lot less RSUs than they'll give you options.
Right. And I think also when you exercise your option, you've got to pay tax on the really the unrealized capital gains if you haven't sold it yet. Where in RSUs, I don't think you have to do that again until you actually sell it.
This is not tax advice or financial advice.
All right, let's talk about one more thing in talent, which is back to office or staying remote and distributed. What are you seeing happening here, the demand from talent and the expectations from companies here in Canada?
So it was interesting. Again, I've had a couple founder dinners over the last couple of days. I actually asked how many people are fully distributed, and everyone said we're trying to do it, but it's not working. And it goes to, I think, the war for talent. Usually, the easiest way to attract people is to be known. So I think the companies that are doing distributed that are really doing it are ones that were born distributed, and or ones that realize they have a very specific hiring case, and that talent is not evenly distributed around the world. So they'll go where that talent is. So they're forced. They're either were born that way and have done it right, or the ones that are forced to because the talent's not locally. What everyone else is telling me is like, hey, we want it. We're open to being distributed. We're not, but everyone's in Toronto even though we don't go to the office. And I think it's because, hey, if you are, let's pick an A-round company. If you rescue, does anyone in San Francisco or New York know who you are right now?
Maybe not.
Maybe, but if you're in Toronto, where KJ's known, where the company's known, you have a lot more brand equity, and it's easier for that person to look at your job offer and get excited to do it. So it's more inbound. So I think what you're seeing is people's stated preference is to go distributed, but lots of people are still very local.
And what do you think is going to happen in the future?
Well, I think
I'll tell you this much: you haven't been to the TechTO office in months. I haven't seen anybody here.
Well, you just don't want me. I come in, the door's locked. It's a new padlock. You're like, Alex, get away. I think the world is hybrid. I think there's advantages to being distributed. There's advantages to being in person. I think companies that don't have a strategy, be it a hub and spoke, a distributed strategy, or an in-office strategy, are going to suffer. So you're going to see companies take a stake in what their culture and nature is. I think what's going to be true though is they're going to build something with a culture with a certain job model in mind, but all of them will be more flexible. Because one thing that I've heard from founders is, yeah, we're still having people come in the office, but it's like 2 to 3 days a week. So we are centralized. We're hiring in Toronto, but let's have them come to the office. Or, hey, we're distributed, but we tell people they don't have to be on. We tell people that everything's done asynchronously, so you can work what hours you want. So if I'm in Vancouver and you're in Tokyo and the other person's in France, we're not trying to get at 6 a.m. for someone. So it's building a model and then adding flexibility around that. And I think the people are going to get crushed. And then what's not going to exist is someone that's like, yeah, we're partially distributed, partly centralized, and I don't know. And we expect everyone to be on calls at noon Eastern on Monday.
Well, we're not going to do noon Eastern on Monday, but on December 8th, we are back in person in Vancouver, and we're going to be joined by Ian Wong, co-founder and CTO at Open Door, and Serge Salinger, the CEO at Visual Ping. And we're going to be talking about the journey to IPO, raising rounds back-to-back, and building companies from the ground up. So you're listening to us now distributed, but we will see you in real life on December 8th in Vancouver.
That's going to be an amazing event.
Yeah, that is going to be one for the record books.
And all right, if I'm if I'm in the audience, maybe ask Ian what he thinks about Zillow, but do not tell him I said ask that.
Yeah, I'm curious. Well, we'll record it and we'll put it up on the YouTubes for those who can't join us live in Vancouver. Next, I want to talk about Web3. What is that?
It's 2 more than Web 1. So Web3 is basically the name given to any site, app, DAO that's using
Project.
project
Yeah.
that's using cryptos and NFTs in a DAO to accomplish what it wants. So it's basically blockchain slash crypto slash NFT slash DAO enabled business.
So what was Web 2 and Web 1?
So we'll start with Web 1. Web 1 was one-way information sharing. The most, think of like Yahoo Sports Scores, ESPN, maybe
Yeah.
Google was Web 1. Web 2, I guess your next question is anything that was user-generated content. So think about YouTube, Reddit, Facebook, which basically said, hey, we don't have to be write only. We can be read and write, and you can participate. So Web 1 is basically we're sending you information. Web 2 is we're going to read and write. Web 3 is, hey, we're enabling blockchain. Another way to look at it, if you take it's Web 3 enables ownership too.
Got it. So if you are a Web 2 companies, a lot of companies today are. How do you think about Web 3 and the impact on your business? Is there a strategy you need to think about how you embrace what's next?
So I think do you think about it? I think everyone's thinking about it. Like I don't have a conversation where someone hasn't gone down the Web3 rabbit hole, as they say, and said, "Oh, how should we engage in our business?" The question is, should you be using Web3 in your model? And I think what does Web3 provide? It provides ownership, enables community, and it enables incentives for people to get involved. So I think if you're a traditional enterprise SaaS business, it's maybe use Web3 for a blockchain to transfer money, but there's really it's more of an infrastructure to improve maybe, but like I'd say 98% of enterprise SaaS Web 2 companies don't need to have Web 3. I think if you're doing something in the creator economy, if you're not using Web 3, or it's I highly wonder about your future and what it looks like. So I think if you have something where you want to incentivize action, you want to get people to have alignment by ownership, or basically build a community, you have to be thinking about how to build Web3 into it.
Maybe that's the very positive outlook on it. Oh, community and shared ownership. Is there a more skeptical take to all this Web3 stuff too?
Speculation.
So how does that work?
Ponzi scheme.
Multi-level marketing.
Multi-level marketing. Like, it's interesting. Do you know who Howard Marks is? So famous investor that started a fund called Oaktree. Like this
Howard Marks.
investor.
Yeah, of course.
Yeah. And actually just listening to a podcast from this morning. He goes, I never understood the value of Bitcoin or crypto. There's no cash flow, because something to be worth money has to have cash flow. And fundamentally, you look at a board ape from Bored Ape Yacht Club NFT. Yep. There's no cash flow inherently related to it. Maybe you can license it out and create a character out of it, but when it was minted, there was nothing there. There's some access, but so the skeptical view is people are just buying this and hoping someone else will buy it at more valuable, more expensive information than you. But what was interesting about what Howard said is he was challenged and said, what is inherent cash flow from a Pollock painting or from gold? Nothing. It's just the belief that people will find value in it and want to own it. So the cynical view is these are people who are buying stuff just hoping to dump it onto the next person for more money. The benign view is that, hey, people like owning something, so that creates value. The other values, there is some intrinsic value that'll be created. Like flip side, Bored Ape Yacht Club as a company or whatever you want to call it has had $1 billion in transactions in 6 months and generated 100 million revenue for the founders. So that's a lot of cash flow, right? So the way you look at it, I think, depends on the way you view the world and how well you know the technology. And certain aspects of Web3 right now are all three of those. There's damn lot of speculation. There's some people that just want to own it. Like a Bitcoin maximalist says, "Fuck gold." Oh, pardon about the swearing, because it's digital gold, so it's better. And then there is utility in what Web3 is being built. And I think the ultimate utility we don't know yet. It's like when mobile came out, and when people started building mobile apps in 2003, we didn't know it. In 2007, you had a better interface. You still didn't know, and then you had Uber all of a sudden, which you couldn't do before mobile. And so you're starting to see stuff now you couldn't do without Web3.
So if you want to keep up to date on all the Web3 trends, another place where you can learn about the latest stories and Web3 is in our 3 times a week newsletters. Alex, what can the community expect in tomorrow's newsletter?
So if you have one of those high quality startups, tomorrow we're going to have a VC spotlight. So you might want to ping that VC. You have my must reads from the week. as well as other notable tech news and stories from the past week. So we might be talking about Hi Mama, for example.
Ooh,
We're
okay.
we're also profile our speakers from upcoming tech fan events. So you want to know a bit more about who Ian is or Serge is, you should be reading it. And just make sure you subscribe because there's no reason not to.
Okay, well, there you go. If you want to subscribe to keep up with the latest news, trends, and advice, you got to visit our website at TechTO.org, or you can subscribe on all our social media platforms. Just look for the link in our bio. All right, now next trend I think is hilarious. FinTech. What is this, 2013, Alex? I feel like this is trend was already passing when we started TechTO 8 years ago.
So why do you think that?
Oh, it was hot then, and everyone said, oh, this is a fad, and people talked about it passing by quickly, but it seems like it just hasn't gone away.
Well, so I think where fintech is, I think it's having it's just basically continues to evolve. Like the thing about the North American economy is over the last 50 years we've financialized everything, right? And so now you're seeing technology as it becomes more and more fundamental to the ecosystem is following that trend. So instead of having new financial products or financialization off the web or often, not using technology, you're seeing more of it. So part of it is Web3, part of it's a financial thing. But if you look at like buy now, pay later, so Klarna, wow, we're done. But like I've seen buy now, pay later for legal services, for rent. Um, I'm seeing people figure out new ways to purchase different assets. You can buy now a Gretzky card as a fractional owner, but I keep on seeing new people looking at real estate going, how can we make it more accessible using finance?
Sure. What
So
about the Constitution? You can buy
the
whatever you
cost,
want.
hey, you might pay lots of gas fees for that. So, but like the point is, I think everyone thought fintech. So we went to the fintech is done. Now it's embedded fintech. And I think embedded fintech is like, hey, let's, Shopify will lend money to its merchants. I think that's still early stages. You're seeing more and more ways to embed fintech. And you're now seeing people create tools to help other people to embed fintech into their business. But I also you're seeing a lot more creativity of how can we apply a financial mindset, and technology allows you to do, because what's finance? It's basically information. So what is technology good at? Data and transferring information, right? It's
Well, it
digital.
seems like when we started TechTO 8 years ago, fintech was its own category. And much like they say in the long run, every business sells ads, it feels like also in the long run, every business in every sector is becoming a fintech.
Well, I think that ads thing is no longer true, because that's what we have. It's all about privacy supposedly now. But everything, my view in every startup, either they're going to have a messaging app or a fintech angle to it. Otherwise, they haven't got their ultimate evolution. They're like the first stage Pokemon. Like the second
Got
one
it.
had, so yeah. So the best ones are the ones that have messaging and fintech in it. Then you're like the super evolved rare Pokemon.
Yeah, that's sometimes what I think about you, Alex. You're like my
Yeah.
super evolved rare
So
Pokemon.
so Jason, when's Well Simple adding messaging?
Stay tuned. Okay, next and last up for our 5 Canadian tech trends of this week, COVID reopening. It has been a long time coming, especially here in Canada. What's happened? Where are we now? And where do you see it going?
So we've talked a lot about over the last year about companies that benefit from COVID. Um, gyms were closed, people can do stuff outside. So video services like StreamYard, who we're using, or Zoom benefited, Peloton benefited. Those are the
Mhm,
big names. And what you're seeing is two things happening. People are actually going back to some of their old routines. They're keeping some of their new ones, but people want to go outside. People want to some people want to return to the office. They're eating out more. So a couple companies that had extreme benefits from COVID have seen a downturn in their numbers or growth. So the streaming companies like Netflix, Disney Plus, and I guess Crave, I would guess Crave, have all seen growth slow or go negative. The connected fitness apps, so like the people working at home, haven't seen necessarily negative, but seen much slower growth. What's interesting, there's some companies you thought would benefit are in this middle ground because we haven't opened as fast as we thought we would. So if you're seeing offices or retail, or you know
What about travel?
live events and
Oh, live events, sure.
like they the companies that survive that, there's a bunch of new ideas out there, are actually in a pretty strong position. But everyone thought last summer we are going to all go out and go back to office and get back to normal, and Delta hit. And now there's this lingering uncertainty where lots of people and enterprises are slower to go back to where we thought they would. And so these companies are starting to see upticks, but they haven't seen upticks expected. So we're in an interesting position for 2022 where some high-flying companies have taken a step back. Like Zoom has definitely seen growth slow down. But there's some of the companies you expect to benefit haven't seen the benefits yet. Travel, I think, somewhere in the middle because lots of parts of I think domestic travel's up back to normal levels. International travel isn't. And so the question for 2022 for like major parts of the economy and lots of startups is, do we return to what's a new normal look like? How fast do we return to that new base? And is it going to be a quarter? Is it going to be another year? Is it going to be another 2 years? And that uncertainty means there's a lot of value to be captured if you get it right.
Okay, well, you're curious to know what you think. You don't have to do it now, but maybe you put it in the newsletter. When do you think that's going to come back, and when's that value going to be captured? Alex, thank you for your insights on these 5 hot trends happening today in the Canadian tech ecosystem. Wow, what an amazing week in Canadian tech. Incredible trends that we covered today. And if you haven't already, you got to like and subscribe to TechTO wherever you're watching or listening right now. And then we'll see you on the inside.
We're in the business of delivering impossible things. We're in the business of delivering things that nobody's ever seen before.
If you build that culture, you'll come up with really cool and innovative stuff, and literally could be the next multi-billion-dollar idea.
So this conversation is largely going to be about scaling yourself and scaling your leadership team.
I want to talk about one of the biggest struggles that I think a lot of startups face early on, which is building initial traction.